Old Square Tax Chambers budget webinar. The budget out obviously just a few hours ago, so this is a case of our immediate reactions. A lot of the headlines are already known to everyone, I suppose, but joining me is Harriet Brown, councillor at Old Square, and Ross Birkbeck, also of Old Square Chambers. My name is Philip Simpson. And so welcome to today's talk. We're going to go for...
Philip, can I just interrupt you a minute? We've got something that's popped up. Somebody is using or wants to use fireflies.ai note taker. Do we object to that?
I don't think so. I should mention, though, that the webinar is going to be recorded and made available on our YouTube channel over the next couple of days. So the content will be out there for public consumption. Just there will be lots of interest in it. So just to kick off overall, a budget standing back with a variety of what might be called minor changes to various bits and pieces of the tax code. Nothing, I don't think, so significant as we've had in the past few years, such as the abolition of non-domiciled regime or other major changes that we've seen. Nothing quite so controversial, possibly, as the reduction in IHT, at least for agriculture and business property, but a variety of smaller changes broadly designed to increase tax, although
it's a looking down the back of a sofa for coins budget, isn't it? A bit.
Yes, it is a bit. It is a bit. With the Office of Budget Responsibility helpfully telling us in advance some of what was going to be going on.
Right.
So I think we're going to take it in turns to cover various topics. There's probably enough for me in the first instance. Harriet or Ross, which one of you would like to kick off with your favourite bit of the budget today?
Oh, well, I'm happy to jump in if Ross doesn't mind.
Go for it, Harriet.
And I'm always happy to be interrupted. I think what we need to say, we need to make it very clear that we're not, this is, when we speak like this, it's never advice, but this is even more not advice than normal because we have had very little time to look at the documents, and indeed the documents that we do have are largely not terribly informative, I have to say. So I was going to start by maybe looking at some of the really basic type changes to income tax thresholds and things like that. Not terribly exciting, but possibly good for the government, good for us, maybe not. So I've been having a bit of a look at the commentary that's already out there. It's not a lot, but there is some stuff out. So PwC have pointed out that this is a budget that's going to. Sorry, do we have some people without sound? Noah, can you sort that, please? Can anyone hear us? Could...
Yeah, I can definitely hear you.
Yeah, can hear.
Sadly,
I can hear you fine.
I can hear.
And I certainly recognise Stuart Brodie there. Welcome, Stuart. Good to have you here with us.
Brilliant, thank you. We seem to have quite a lot of people saying they have got sound now. Stephen, you've got your hand up. Can we help?
That was just to say I'm here and I can hear you. Sorry.
Oh, no, that's fabulous. Thank you. That's great. Cheers.
Not great on Teams, to be honest. Anyway, there we go.
Well, clearly neither are we, as not everybody has sound, but we'll see how we go. I think Noah will look into that for us. If there's anything we can do, we will do it. So PwC have characterised this as a budget of fiscal drag. Tax Policy Associates have sort of termed it a budget that looks primarily to fiscal to rates freezings, which then means that you get fiscal creep. And that's very much what the rate freezes are going to do. So we've got several rate freezes. We've got income tax, NICs, and the IHT nil rate band. I saw an interesting statistic yesterday, which said that if the IHT nil rate band since 2009, which was the last time it was increased, I think that was a modest £12,500 to recollection, but don't quote me on that. If it had increased in line with inflation, it would now be just over £504,000. So a key point to note about these rate band freezes is that PwC say nearly a quarter of taxpayers will be paying the higher rate by 2030. Tax policy associates say that the key tax raising measure here is fiscal creep. And they say that it's one of the largest medium-term tax rises of recent years, with a 30 billion rise by 2030, 2031. So while those rate band freezes look pretty benign, they are effectively a huge way to raise money. And I did have the figures, but I can't remember where I've put them. Was it that one? It's this one. So yes, so if we look at those rate freezes, fiscal creep has been, this is from an IFS report from 2023, has been the largest single tax raising measure since 1979. And the OBR is saying that fiscal creep will raise 32 billion in 26-27 and 39 billion in 29-30, making it likely the largest overall tax increase for a single policy in the post-war period. So I have, as I say, I have tax policy associates to thank for that. So you may think, well, rate band freeze is not very interesting. And from a legislative perspective, for barristers, accountants, they're probably not very interesting. From a tax perspective, they are very important. Couple of other things on this, on sort of income tax basic changes. We have got a proposal that self-assessment taxes are going to be paid automatically throughout the year. There's not a lot of details on that yet. It's going to be fascinating to see how HMRC are going to manage that, but I'm sure we will see in time. And the other point that we have is, which is sort of basic, is different tax, different income, different rates. So the rates for property income, dividend income, and savings income are being changed. I don't know if Ross or Philip wanted to jump in on that one at all. No one's looking very jumpy.
Well, I think it's perhaps Ross's turn to.
I'm not sure I've got much to say there. It seems to me, you know, how they ban for property income in relation to other income will perhaps be the only detail to be ironed out. So no, I mean, it seems, as you say, a lot of these is these sort of headline changes are from a sort of our point of view, or from my point of view at least, you know, fairly straightforward.
I mean, all I would say about that is it does potentially open up gaps through which people might wiggle if they wanted to get a reduced rate of tax. I can't really see any particularly obvious, from the stated policy, obvious opportunities, but that's a possibility. And of course, it's making the tax code more complex, not less complex, which we always complain about.
Yeah.
Yes, I mean, you might have thought sort of some sort of simplification measure might be to get rid of this reduction in the personal allowance from £100,000 onwards, and add a wee extra income tax rate from then to avoid the sort of distortions that we're coming to hear of now in terms of people, you know, sole traders keeping their profits just below £100,000, or people taking, you know, a couple of months off work at the end of the year, that sort of thing. But I suppose at least politically, giving individuals earning more than £100,000 tax-free allowance is perhaps not the way this particular government would like to go. So much for rate freezes. Thank you, Harriet. Ross, what's your highlight of today's budget?
Well, I mean, as I say, the thing, I mean, the things that jump out at me are perhaps, smaller changes that whether or not they'll how interesting they'll be. I was looking at the changes to the EIS, SEIS, and EMI enterprise investment rules that have been announced, which actually it is again substantially just a rate change in a different form. They're changing. They're not going to change the rules by the looks of things. So the law will continue to apply as it was, but by raising the levels, they're going to bring in a lot more companies and opportunity to use these reliefs into the market. So in some ways, I was looking at that because what I tend to see with those reliefs is questions about exactly how they apply and whether the criteria for trading, etc., are met. That all looks like it's going to be the same, but I wonder whether we'll if we do see a significant expansion in the use of these reliefs, whether we'll see more of those questions coming through.
I mean, given they're making changes here and given the volume of litigation there has been in the last 7 or 8 years on things like what's the trading requirement, whether or not you've got a disqualified activity, things like that, it would have been a good opportunity to maybe give some clarification as well, but there's no indication I think that we're getting that. Is that right?
No, I mean, perhaps the most interesting bit is they're also starting a consultation, which is looks quite open in terms, essentially asking everybody to say, well, how can we make this even more effective, and how can we promote sort of entrepreneurship by changing the rules further? So they do seem open to that, and I wonder if that'll be the result of the consultation. Is clarity in those areas will help bring in this kind of confidence people need. I mean, it's notable there's also some suggested changes to the R&D relief, and this is similar sort of entertainment industry reliefs where they are bringing in procedural changes to simplify and clarify some of the rules as about to what happens when you trade credits within groups and that sort of thing that has so far created quite a bit of uncertainty. So maybe obviously they changed the rules and the way the RDEC works and stuff fairly recently, and now that they feel that it looks like they're continuing to tidy up. So if that's the same direction of travel with EIS and EMI, then and the VCT trusts, then maybe that's where we're going.
Well, I think that would be a good thing, though. In some ways, it's slightly strange because a lot of the litigation of which I'm aware has arisen out of HMRC policy changes, which have been to interpret the legislation more narrowly than they had previously. So I've had a number of cases where companies have been issuing shares on the same basis, and then HMRC have said actually no at a certain point because their policy on interpretation has changed, and yet this seems to be broadly in favour of widening accessibility.
Yeah, mixed messages.
Yeah, certainly. Also with VCTs, I think in particular the HMRC have been capable of being persuaded to take a slightly broader view of things like conditions for follow-on funding after the initial investment period. And yes, the other thing in this budget is responses that have now been received and summarized to the call for evidence a couple of years ago about more employee-based, entrepreneur-based advantage share schemes. So the SAYE scheme and the share incentive plan arrangements. The responses were published today in summary form, although all that the government is saying so far is that HMRC are going to go away and think about whether any of the suggested changes will be made, and will generally work to improve the administration of these two types of relief. So
we've had the publication of quite a lot of consultation response, haven't we? But without really any substantive action plan to follow.
Yes. I mean, I suppose one place in which sort of the opposite has happened in this context is the changes that are going to be made to capital gains tax relief on transfers into employee ownership trusts, where relief is going to be quite significantly reduced. So these employee ownership trusts came into being, I think it was 2014, so that a business owner broadly who was going to pass ownership to employees via a trust mechanism could get full capital gains tax relief on the transfer, even if the seller owner was going to be paid over a period of years, effectively out of dividends, future dividends. That relief is going to be reduced to 50% of the total amount. Not entirely clear the mechanism by which this is going to be done. But I suppose that likewise goes with the flow in relation to employee ownership trust over the past few years, where conditions have been slightly tightened up to avoid what were becoming quite well used or frequently used loopholes involving, for example, offshore trustees. That was one that was tightened up last year. So again, quite a lot of sort of small changes in or potential changes for these types of areas.
Sorry, I think the employee ownership trust changes, those are aimed at, I'm going to call it perceived abuse. So I think things that sort of clearly come within the wording of the statute, but which hadn't, I think it was thought that this would be sort of almost like passing on to cooperatives and things like that. And it's been used more for quite small, close companies. And I think maybe as I understand it, that is something that has driven the decision here.
It seems an odd though in that respect, doesn't it? I mean, it's a certain element. It seems billed as if it's aligning with the, agricultural relief and business property relief 50% sort of limits. But if it's an anti-avoidance measure to stop these things being abused, you would have thought tightening the rules and not allowing the people you don't want to get it at all would be the way to go, rather than limiting it for everybody who. So then the legitimate, the companies for whom the policy was put in place and the arrangements it was trying to encourage are still allowed to get the relief. It seems a sort of confused mixture of purpose.
It really does, and given the willingness to smack a targeted anti-avoidance rule into any regime that people feel is being used in a manner it was never intended to be, I agree, it does seem like a slightly odd choice to restrict that relief in that way. And again, I'm not completely sure as to the logic behind that.
Okay, turning, if I may, to one of the ones that I think is quite interesting, though how it's actually going to work is all a bit unclear yet, is the advanced tax certainty for major projects consultation. So certainly one of the problems that advisors have come across over the past few years has been the fact that HMRC have sometimes taken rather a long time to respond to requests for advance clearance, particularly non-statutory advance clearances. There is a policy whereby HMRC, except in complex cases, are supposed to provide a final answer within 28 days. If it is a complex case, at least supposed to acknowledge the request in 28 days and agree a timeline for providing a final answer. Now, that's to an extent been more honoured in the breach than in the observance, I suppose. Although one can understand that the pressures HMRC have been under over the past few years from staff cuts obviously have that sort of effect on service. And I always think it's a bit short-sighted of governments to cut the budget for HMRC itself. It's one government department that actually makes money. There it is. but at least there's some sort of intention to help taxpayers get more certainty about how major projects are going to be treated. Say the consultation result was published today. We're promised a new advanced tax certainty service from July 2026.
And I think there's a pilot prior to that, isn't there? There's going to be a pilot from March for certain types of transaction I saw somewhere.
Yes, I hadn't noticed that, I have to confess, but
that is the
Harriet
problem.
spots
You
all
get
these things.
so many documents and so much. I mean, I can't remember where I saw it now, if it was in the main budget, if it was in the consultation or somewhere else altogether. But I think there is going to be a pilot from 2026 for a smaller sector of projects.
Yes, so that would be at least some chance for HMRC to refine how they actually do this in advance of it coming online in July. Although I suppose 4 months is perhaps not a huge amount of time in the context of starting up this new service, but I think certainly a welcome thing from HMRC, albeit as always it depends on how it is going to be implemented and whether practitioners do find it as helpful as one might hope it's going to be. I think there's some other more procedural things, more administration type things. I'm not sure if either of you want to mention any of those.
There's one
move
that
back onto more substantive stuff.
There's one that I find really interesting, which again, a lot of what is interesting about this budget is not what is ultimately going to engage us as tax practitioners. But one of the things that I find really interesting is this proposal of a reward for informants of high value tax fraud. And the proposal as it stands is that where you provide information that leads to the recovery of £1.5 million of tax or more, you can get a reward of up to 30%. So in the design, that is a very substantial.
It's quite complicated, but getting there. Yeah.
Yep. So I think someone's got their microphone on. If you wouldn't mind just checking your microphones are off, please.
Just seeing if I could see who it was, but I can't. Anyway, I will keep going. And so I think that's very interesting and has potential to use an awful lot of HMRC time to limited ends, I suppose. Potentially, I don't know. Some of the other things that we've got coming, we've got new consultations on reducing promoters. Sorry, I'm cracking down on promoters again. We've got more to come on revenue sanctions and powers against advisors who facilitate non-compliance. Again, there's very little detail on these, but this is interestingly one of the things that the OBR has identified as important in this budget is the compliance package, because they say that is going to materially reduce the tax gap. I can't remember by quite how much. From about just under 5.5% to just it's by nearly a percent. So I'm not sure whether or not that's going to be worth it, but clearly they think it will. So actually the administrative parts of this package are a more significant aspect of it. We've also got there's the threat of a penalty regime update, which were it to be a full penalty regime update, I think would be very useful, because the penalty regime at the moment is all over the place. It's dotted through different acts. Some bit applies. It's not consistent as to which bits apply to which taxes, in terms of, well, all sorts of things. It's scattered throughout the legislation, and a consolidation and rationalisation, I think, would be very welcome. I don't know if that's what's proposed at this stage. And then we just have a reminder. It's something that's been kicking around for ages, but is coming in from next year, which is domestic reporting in relation to UK resident crypto asset users under the crypto asset reporting framework. If you don't know anything about the crypto asset reporting framework, we do have a couple of videos about it on our YouTube channel. They might be slightly out of date as to things like when it comes in, but the essential framework hasn't changed. So do have a look at those. So that's not new, but that is now imminent, if I can put it that way. And I think the only other thing that I've really got under the head of administration is obviously Ray McGann has carried out a review of the loan charge, and we are going to get a new settlement opportunity.
A very generous one, it seems.
Yes. Do you want to give us some of the details of that, Ross? If you can.
Yeah, well, essentially, I mean, Ray McCann's, his review conclusion has come back highly critical of the way the loan charge has been handled, and sort of essentially exasperated at the fact that it's still not done. And still there's huge numbers of people facing these loan charge liabilities in an unresolved situations. And I think essentially he's like, look, the most important thing is we get this settled in a way that is roughly fair. And what that looks like is essentially going back and looking at the loans that were received, figuring out how much tax would have been paid in those years, in addition to what was paid, and settling on the basis of just the additional payment of that, no interest, no penalties, broadly. And the government has accepted this essentially in full, and has even gone further. McCann was suggesting a sort of suspended, or the rest of the tax you would be due under the loan charges sort of suspended, but the government said actually no, that's too much bother, too much uncertainty for people hanging over them. Let's just write it off. So that's potentially very good news for anyone with loan charge liabilities. The really interesting question, I think, from my point of view, is what happens to all the existing disputes. I mean, we've got litigation ongoing and all of that, and is all that going to come cracking down on the basis that, well, we got an assessment to tax the revenue and now compelled to settle it under the new terms of this these review conclusions. I mean, for example, one of the recommendations is that companies who claimed deductions for contributions into these DR schemes, the revenue had been doggedly insisting that they shouldn't get them because they weren't wholly exclusively for the trade. The review recommends the revenue settle on the basis that those deductions are allowable, for example. So there's a huge reversals in policy from the revenue potentially on the horizon as a result of this.
And will people who settled under the last DR scheme be allowed to resettle, or are they stuck? Presumably they're stuck.
It's pretty vague on that. Yeah, I think the suggestion is not to open up things that are already dealt with. But there is talk in those conclusions about, well, this is only in relation to loan charge liabilities, right? So if you've got a pre-2010 liability, which obviously wasn't caught by the loan charge, but the revenue is still pursuing people under the Rangers principles for pre-2010 loans, the review's like, well, it's outrageous that those are still outstanding and haven't been resolved yet, and essentially they should be settled on a broadly similar principle. But it's vaguer about that, and so they're going to legislate for new powers to settle here. So we're going to get a new settlement power in the primary legislation in April, which will, the extent to which it will allow as opposed to force HMRC to settle, will be one of the interesting things. And whether we'll see JR if it's the latter.
Well, I mean, yes, I mean, technically the last one forced them to settle, but not necessarily noticeably, did it? And I had numerous clients, some who we got as far as trying to bring JR, and others who didn't have the stomach for it, and one where we threatened JR and then the HMRC changed their mind. I count that as a win, by the way. That goes on the win side. But it's been hugely contentious all the way through. And I mean, I think there was a recent case that Rory was in, and was it Airedale, where there were a number of companies who had tried to use the scheme and tried to use the redress scheme, and I thought that the judicial review decision was fairly harsh on that one, as it has been in a number of cases in terms of how things have been interpreted and applied. But yeah, so
Yeah.
how enforceable being forced to is another question,
Yeah.
I think.
Yeah. But the big picture seems to be the government recognising on the basis that the essentially the loan charge was a disaster, and we want to put it all, but we all want to put it behind us. And the other interesting thing I think that comes out of it is some questions about DOTAS and going forwards about how the revenue can communicate better and how DOTAS can be modified. So there might also be some other things coming out of this that are worth keeping an eye on in terms of the sort of general disclosure and avoidance.
Because again,
Okay.
DOTAS, rationalisation of DOTAS would, I think, be welcome, wouldn't it? That's not the most straightforward regime to get to grips with in terms of how it presents itself on the page.
Yeah, I mean,
Yes,
it doesn't seem.
sorry, I was just going to say that all the slight differences between the tests and the various DOTAS markers on what counts as tax avoidance or what you need to have in terms of your main arrangement or purpose or whatever. Certainly, the legislation must be capable of being simplified.
Yeah.
But
that's, I was going to say that's one of my worries about the new, again, more talk of sort of penalising enablers and promoters, etc. And again, we have those very difficult tests in the middle of all that legislation about tax avoidance arrangements. Essentially,
got something in the meantime.
Oh, someone else got their mic on. One can check. I've
gone through and muted them.
So I'm not sure the proposals in the current policy paper really indicate they're going to do anything about those fundamental difficulties in DOTAS or POTAS or etc. But we'll see.
Yes. Yeah, I suppose just one other thing to mention in relation to the loan charges, that I think one of the proposals that's being accepted is not to make any inheritance tax charges on schemes. That's going to make quite a big difference when the schemes get to the end of their lives, I suppose.
Because they must have been very dogged on. In fact, the other thing very important to say is also they're putting a floor and a cap on it. So the idea is you won't be able to settle over a certain amount. So people who have a lot of outstanding loan charge liabilities are not going to get the same sweet deal as people with less. So it's weighted to be more favourable to those with lower amounts of outstanding loans, essentially.
Which I suppose has always been one of the aims, hasn't it? Is the people who effectively may well have been dragged in not quite knowing what they were getting themselves into, which tends to happen at that lower end.
Yes, exactly.
I think the assumption is.
Yeah, the less the lower earning people who go through these umbrella companies that operated these loan charge schemes, and yes, who didn't really know what they were getting into, because they're just simply not sophisticated in terms of how the tax system works, and were sort of left high and dry by certain tax advisors, shall we say, who structure the arrangement so there's more or less no comeback against them from anyone, which seems a bit tricky. So yeah, you can understand equally why more sophisticated individuals with higher incomes who have used these type of schemes don't get quite so much sympathy. Hence, I suppose the cap on the settlement opportunity.
And also just the general lesser sympathy for people with more money, full stop, which we seem to have as part of our national pastime.
Yes.
So, Philip, go on. Sorry, I apologise.
So no, not at all. I was just going to move on to maybe just a couple of headlines for other tax, I suppose, going through some of the indirect tax matters. Point about VAT. There's going to be, let me just find it. It's changes to the VAT treatment of private hire vehicles. Basically, There's been lots of legislation with companies, litigation with companies like Uber and Bolt, I think, had a first-tier tribunal as well about structures whereby the model they operate is worked out so that VAT arises only on the commission that Uber, Bolt, etc. charge. One of the things that happened was that Bolt persuaded the first-tier tribunal that it should be within the tour operators margin scheme, so that is going to be abolished as a possible answer to the HMRC seeking VAT on the full amount of a fare. Obviously, it still leaves open the possibility of having what's called an agency model in that context, and inevitably we will have to see what legislation says in due course. As often the case in tax law, it's all a bit confused by the way tax law interacts with what one might call normal law, in this case Local Government Act 1976, I think it is, and how it provides for licensing of private car hire operators, drivers, and actual vehicles. But an interesting response, I think, by HMRC to ongoing litigation. Apart from that, sort of more minor things with indirect taxes, no more customs or now import duty relief. Of course, we don't have customs duty anymore since Brexit. We've got import duty. No more relief from that for low-value imports of under £135, but a consultation before that relief gets abolished of how to work out the administration of it. Air passenger duty on private jets above, I think 5.7 tons is going to be at the higher level, which perhaps not of great interest to the majority of taxpayers. Follows a consultation to which there were 1,730 responses, which is an awful lot of responses for any tax consultation. Curious to see where they all came from, but I haven't had time to analyze the list yet. And the digital services tax review has come out. The summary report on the mandatory review that the government has to carry out just now, and broadly says that digital services tax is doing a very good job, £800 million last year apparently. No sign of any avoidance or fraud, obviously very good, but will continue as an interim measure until there's a global solution to the problem of digital services, which I suggest means is here to stay for quite a long time yet.
Well, you see, I thought that there was in the process of being developed a solution to the global problem of digital services, but there we go. Apparently, that's not good enough.
Definitely the process, Harriet. But, these processes can take their time.
And I think that might be a good point to mention. We don't have any massive sort of non-resident offshore type announcements, but there are some things that are going on that are quite interesting. We have obviously the big one, which also ties in with duties and excise, is the changes to gaming duties, which I think in the speech were framed in terms of the most damaging types of gambling. And I'm not sure what the evidence for that was, but I'll leave that where it is. But to me, the I think the biggest rises are on digital gaming and digital betting, and that will obviously have a huge impact on offshore operators, because almost all of these digital gambling services are run offshore. So that is again, obviously the things that are UK situate and unlikely to run away, like horse betting. Great pun there that I didn't mean to do. Are not being altered, and of course we get the abolition of bingo tax or whatever it was, which is very nice. I don't know any details of that, but I'm not going to bother learning any because it's going. So that's probably the biggest one in terms of how people are going to look at the impact of that. In terms of how much money that's going to raise, it is it's predicted to be one of the biggest revenue raisers in this package of measures, with 1,155 million. Is that 1.155 billion by 2030-31? So that's one of the biggest. So big in all senses of the word. Other offshore aspects. There's going to be abolished the opportunity to make voluntary Class 3 national insurance contributions when you are non-UK resident. Broadly speaking, you can currently do this in order to ensure that, say, if you've left the UK, you retain access to certain benefits should you come back. That is now being abolished. There is also going to be the abolition of the non-UK resident dividend tax credit, which really just brings the position into line with the position for UK residents. We are going to be getting a new consultation on offshore anti-avoidance legislation. And I'm mentioning this one because I haven't been able to work out what it is. There is no bleak reference in the actual budget document itself to closing capital gains tax loopholes for protected cell companies. So if anyone is better informed on what those loopholes might be than me, I'd be delighted to hear them. I can guess at a couple of things, but I'm not sufficiently certain to make those guesses public. So those are the key things happening offshore. The big one being gaming duty. And in the future, if we do get a new offshore anti-avoidance legislative package, that will obviously be big news, but that's sort of something that is in consideration. It's not something that we're looking at here specifically.
Thank you, Harriet. So I suppose you're saying that one of the things is bingo duty is still with us, but not for long. If I can have a horse-related pun as well.
If you can hold off for a few months, Philip, if you can keep your bingo obsession in check, it'll get cheaper.
I totally will. There you go. Ross, you're shaking your head and I quite understand. Over to you.
One of the other things that got my attention was we're getting a new chunk to the intermediaries legislation, as trailed last year, part 11, chapter 11 rather, in relation to umbrella companies and chains of agencies, which is rather ominously looks like it's going to be very much on the basis of chapter 10, which is one of the most convoluted pieces of legislation we have the misfortune to have to engage with. Hopefully we'll get the legislation fairly soon, and it will either be on exactly the same basis, so I at least will be used to the silly way it's drafted, or something much easier. But that's. And I just wanted that seems like it could be a fairly relevant change. I mean, it's essentially a PAYE allocation rule, as is Chapter 10, but can have quite a big impact, especially when you think. I mean, I've seen a lot of people very confused about how the public and large company IR35 rules work in the context of anything but a very regular employment situation. So we'll see whether we have similar problems with Chapter 11 when it comes.
Yeah, just one other income tax one to mention at the moment. The limits on salary sacrifice arrangements in relation to pension contributions. Pensions obviously a very difficult area for a number of years now and going forward. constantly changing field with lots of uncertainty about how one can actually save to end up with an adequate pension. The state pension, of course, going up by £440, I think it is, per month. But salary sacrifice for making pensions contributions is going to be restricted, capped at £2,000 a year for employee contributions, instead of, I suppose, the more general limit of £6,000 a year on personal contributions into a pension plan. I'm not sure of what the consequences of that's going to be. Let me just see what the there's no estimate about how much this is going to bring into the exchequer or cost the exchequer. I suppose it might be thought
there is.
bring
It's
some, but is it all right?
There is. It's tucked away. So it is estimated that in 2029-30 it will be 4,845 million. And in 2030-31, 2,585 million, making it by far the biggest predicted revenue raiser of anything in this entire budget. Even bigger than the further measures to close the tax gap, which is predicted to top out in 30/31 at 2,590 million. What is interesting is if you look through those figures slightly further, what you see is that it is absolutely dwarfed by the decision not to proceed with the Spring Statement 2025 reforms to eligibility for personal independence payments, both generally and within those last 2 years. The amounts that you are winning back with your salary sacrifice and you're closing the tax gap do not equal the amounts that you're losing by not making those changes. So it's an interesting way to look at it.
Yeah, yes, indeed. And Harry, you must tell me at some point how you managed to assimilate this in the past 5 hours, because that's been certainly beyond me. Yes, other points. I suppose the minor things interesting. Overall, the fact that electric cars and hybrid cars are going to be subject to a per mile tax. A new tax come in for them. The theory being, of course, that they contribute less to the cost of the road system as people who drive them don't buy petrol or as much petrol, and therefore don't contribute by excise duty on petrol. And so
I have a plug-in hybrid electric vehicle, and I still feel like I buy a lot of petrol.
Yes, I mean, I've got one too. It very much depends on what sort of journeys you make. I mean, I suppose we find that generally just around town during the week, we can live almost entirely off electricity, which of course we get for free from our solar panels, except in the Scottish winter for daylight and sunshine are at a premium. It's 10 to 6 now. It's been dark up in Edinburgh here for about an hour or so, at least hour and a half probably. But yeah, so rate's going to be 3 pence per mile for full electric vehicles, 1.5 pence per mile for plug-in hybrids, which let's say 10,000 miles a year, you pay £300 for an electric vehicle, 150 for a hybrid. And so that's, I think, going to come in the next couple of years. But still, of course, by 2030, no new sales of petrol cars. And I suppose this is one way of balancing out the loss of excise duty from petrol and at least ensuring some sort of fair contribution to the cost of the national road system. and that was my other. Does that count? That probably does count as indirect tax, I think. Let's
I-
You
call it
know how it's going to
indirect
be
tax.
collected?
I don't know. I haven't seen that yet. I would imagine it might be somehow collected with your annual road tax amount. That would seem the obvious way to me, but to put in your
Yeah, so
mileage as well as your
self-reporting.
CO2 emissions and so on.
They're going to repurpose the tooth fairy.
Yes. How they might do it apart from that, I don't know. I can't imagine any idea of sort of somehow automatic some sort of communication with cars themselves.
Or through
so
the
it
MOT
must be-
procedure, I was wondering.
Oh,
but-
that's clever. Yeah.
Cars
But
under
would-
3 years old don't have an MOT,
yeah,
though,
wouldn't
do they?
cover new cars
That's
anyway.
true.
So
That's true. Yeah.
you know, I just wonder
Yeah.
whether. Anyway.
Now, I can see that we haven't got much time left, so I would like to chip in, unless somebody else would like to, with a couple of bits on IHT, if that's all
Absolutely,
right.
Harriet, absolutely.
So there are two things that have caught my interest. One is obviously this decision to make that 1 million nil rate APR BPR amount available to be transferred between two spouses. So if you died and transferred agricultural property worth £500,000, your spouse could have the remaining £500,000, I think, is basically the proposal, in 19 seconds or so. I think that's a sensible idea. I think I saw that the Welsh Farmers Union described this as a very small concession, and I suppose that's probably correct. The other one, which is a bit more specialist possibly, is that there is going to be a capping of relevant property trust charges on what's being referred to as historic trusts, and that cap is going to be 5 million. So that is a little bit of sort of good news, I suppose, for non-doms or former non-doms, as we don't have them anymore. In that the maximum IHT across a former excluded property trust will be 5 million, but we still don't, I think, have the details on what constitutes an historic trust. But again, I think that is important and one that's worth watching and looking out for. And that's my IHT bit.
And sorry, I just had a quick look at the consultation document on electric vehicles, and yes, it is going to be, the plan is to do it through the annual road tax online thing one has to do. So that's at least the current proposal for that. Yeah, sorry, I see it's just come up for 6 minutes to 6. Any last thoughts, Ross?
Oh, last thoughts. I'm still on first thoughts.
Any last first thoughts?
Probably they keep on coming up. None that spring to mind.
Stamp taxes on shares is going to be reformed.
Yes,
I think
we've
that's a
been
good
promised that
last first
for
thought.
some time. Yeah.
And we're going to get a 40% first year writing down allowance for capital assets as well, which I think is quite a good thing.
Yeah, but no plans to abolish stamp duty land tax, despite the plea of Kirsty Allsop for that boon. Not that she's involved in the property sales market at all, and might benefit from that. But there you go.
One other thing, mandatory tax advisor registration is going to be an interesting. See how that rolls out. Thrown in there. There doesn't seem to be many details yet.
Whenever we get these changes, we always seem to come up across unanticipated problems. I've been involved in trying to advocate in relation to some of those unanticipated problems. And I think given the breadth of what constitutes a tax advisor, it is quite difficult to get a regime that is workable and that achieves the aim. And you may be, I mean, I'm in principle quite in favour of the idea, because we all know there is some very poor tax advice out there. But I think it is getting a properly workable scheme is very difficult. And generally it's precisely the sorts of people who you want encapsulated who aren't.
Yeah.
But let's see, maybe I'm wrong about this effort.
No, yeah, I mean, there's no requirement to register for legal advice, and anyone can give that, and tax advice seems to be the same. So, yeah, it'll be interesting to see what they do, and whether those are the people who are already, if you're already a legal professional, whether you fall within that description, etc., etc. There's so much uncertainty, and seems to have difficulty.
Yes, I guess the ultimate aim of the proposal when it kicked off was to ensure that people who gave tax advice were regulated somehow. So you'd hope that, for example, people who are already regulated by a law society or the Bar Council wouldn't need to have another registration with someone else, which would doubtless add some expense and some administration and to one's life, which would seem to be a bit unnecessary. When the basic idea was to make sure that there was some oversight by someone of everyone who gives tax advice, however that might be defined. But anyway, I think we're probably coming to an end, unless either Harriet or Ross wants to take up anything else.
No. I feel duty bound to say it. So I'll be speaking at a Key Haven seminar on the 9th of December, where I'll be looking at some of these more interesting detail questions or issues or changes in more considered detail, let's say, if anyone's interested. So I should advertise that. But
I think well, the only thing I would say is we've undoubtedly missed interesting things. We've undoubtedly probably talked about things which, with hindsight, won't be interesting. This is obviously, as with all budgets nowadays, this will keep developing as we start getting the draft legislation, the finance bill, more clarity on how the government is going to respond to consultation responses. So keep looking at it, and yeah, we will no doubt, I think, all at some point in future months be talking about aspects of this again.
Yes, thanks, and yeah, I'm happy to admit that no doubt I've missed things, but the impression that you and Ross have both given, Harriet, is that you've got to the grips with the detail of quite a lot of it in a very short space of time.
Well,
so,
it's
a misleading impression if that is indeed the impression, but yes.
No, don't tell them.
give me a year.
Right.
And just to say, thank you to everybody for coming on what has no doubt been a busy day for most of us, if not all of us.
Thank you very much, and no doubt be in touch. Bye for now.